There you go, another Sunday morning and another weekly market recap. Now, let's try to make it quick, at least for what concerns the usual charts about, currencies, gold, oil, Bitcoin, and so on and so forth. Because, as you might have grasped by the thumbnail, the talk of the hour, or should I say the talk of the week, was Jerome Powell talking at the Jackson Hole Symposium. And, even if we, as if we needed even more confirmations, the eventuality, possibility, opportunity of rates cuts has been, at this point, it's a done deal. I mean, even Jay Powell said that. Um, the the words where it's something like it's now time for policy to adjust. No shit, Sherlock. I mean, we are gonna look at it in a minute, but I thought, I thought honestly when I heard him talking in July, at least it gave me the impression uh, it, it, it wouldn't it wouldn't have bothered even cutting a little bit in July. He hinted at a lot of things like the data from the labor market might be overestimated, and you know it was looking like he wanted to cut already a little bit, just to not to overshoot, but at the end it didn't. Maybe there were some hooks in the committee which didn't let him, because more often than not there must be, at least quote unquote must be, this sort of a unanimity in the council so that they come up as a united front, you know, for the public, for the press, for everyone else, for the market, more often than not. But yeah, well, it is what it is. We got what we got, but it looks like it's now time. So let's start, as usual, by looking at the economic calendar. There weren't a lot of, you know, very or massively interesting data points this week. I mean, we got PMI, yeah, sure. The manufacturing came in a little bit weaker than expected. Again, no surprise there. The manufacturing sector is in contraction, and has been in contraction for a while now. Um, the I guess one bullet point right at the beginning. I guess the reason why many people forecasting recession in the U.S. basing the old premise around manufacturing slowing down. I guess they forgot that 70 to 80% of the economy in the US is made up of consumption. So, manufacturing makes up for like what, 20, 25%. So it can slow down, but overall, uh, the economy at large can still be resilient. And, we've seen it. Then, of course, we've seen it also because with the massive amount of money helicoptered to households, to with the PPPs and all the student loans forgiven, there was a massive boost in monetary terms to the economy. So the buffer that the federal government actually created was more than enough to kind of kick the can down the road, way more than what people were expecting, myself included. I have to raise my hand saying I'm guilty as charged. In 2023, or even before then, when they started to raise rates, I was like, it's impossible. Power will be able to go above 3% without making especially the credit market, especially imploding. Guess what? There's always a way by which these policymakers and the markets can humble you and surprise you. So always be careful. Besides the little tangent there, as I said, we had the majority of the attention was on the Jackson Hole Symposium, and the message was delivered, and the market was reassured we are going to see rate cuts. I mean, I think the way the whole thing has been brought up, it's kind of good, even for Powell, I guess, because uh, he he always tried to never spook the market, never surprise the market. Always being particularly clear, even throughout all his speeches. He never tried to come in the press conference and actually surprising the market with some out of the blue type of decision. It was very vocal about what he was intending to do. And so, I guess, sometimes, even in my opinion, you gotta give credit where credit is due. So good luck, Jay Powell. Was a nice. I mean, if you have to run up PSYOP, it's better if you do it this way, right? So I guess from his perspective, he did a good job. And I mean, the market at the end of the day, it's not collapsed like many other people were saying, 30, 40, 30%, 50% even collapse for the stock market in the US. And it never happened. So bravo, Jay Powell so far, at least in that aspect, right? But let's have a look very quickly at currencies. And we see, as I often say, be careful what you wish for because you might get it. Because I remember I was looking at the euro and the pound, the British pound, and I was wondering, oh, I wonder why the British pound is not following along with the euro. It's lagging behind a lot. Maybe it will, and it actually will. It did, sorry. So these are what? One, two, three, four. Well, more than 6 days with straight up upside. Nice one. The euro continued to come, back up. And of course, conversely, the DXY is now retesting the range low of the macro consolidation we have been looking at for basically since I started recording these podcasts, these videos, or whatever you. What it's gonna be? Because I'm already reading stuff about if you weren't convinced before, now you need to see that this is the demise of the dollar, yada yada. I don't think so. Yeah, I mean, it can go up and down in the FX market against other fiat, but when people say this is the demise of the dollar as the reserve currency status, I still disagree. I mean, it might be in 10, 15, maybe 20 years, but surely it's not going to be now, the way I see it, at the very least. As for the Japanese yen, which is already, no, it's not, sorry. Now it's inverted. So even the Japanese yen had this little bit of a pullback right here after the unwind of the carry trade, and I mean, it looks like it drew back a little bit, and now it is bouncing. It's bouncing a little bit. So again, with these carry trade unwinding, is it said and done? I mean, it looked like it was a big spike in fear and emotionally responses by the markets, and then it was like, it's already in the past, right? But what if it keeps on going higher, right? The yen against the USD. That will impair that inflow of liquidity which was given by the carry trade itself. I mean, it would make the opportunity of taking advantage of it uh, less desirable, I think, less practical. So another thing to monitor going ahead. So it's going to be interesting to see what's going to happen there, I guess. I think, at the end of the day, what's really important, beside the trend, which is always important, absolutely. But I think the thing which hurts markets the most is the rate of change. So the the velocity, the speed at which something can unfold itself, right? Because people have been caught off guard more often than not, and they were massively over leveraged. So that's where you see a deleveraging event, price, a repricing event of that sort that we have witnessed throughout August in that, during that infamous Monday, right? But other than that, I don't see any other thing of particular relevancy in currencies right now, at least in these four. I mean, I could look at the others like the Swissy, the OC, and the BRICS. Uh, I don't think the BRICS have changed around very much, at least on a larger time frame, like a weekly, a monthly, and so on and so forth. But I mean, the same way I don't buy into this de-dollarization, the US dollar being thrown like next year. It looks like every single year, like it's like next year the US dollar is going to lose reserve currency status. So the same way as I don't see that possible, I don't see the BRICS being the prominent force in market like next year. Again, 5, 10, 15 years down the road, everything can happen. I don't trade for 15 years down the road, right? Let's have a look at oil. Oil came back down. Had a little bit of a relief rally, a little bit of a bounce. It still looks a bit weak, even if it's bouncing a little bit. And all in all, it's still in this large macro range right here. It's not, I mean, I guess it's fine. The same logic applies as long as you don't have massive spikes in oil. If price can move slowly, I guess the other actors in financial markets and the real economy have the time to readjust themselves. So I'm not seeing a particular dangers in oil right now. I mean, they're still talking about this process of peacekeeping in the Middle East. Throughout the week, at the beginning of the week, it looked like the agreement in between Israel and Iran was kind of on the way to be confirmed. And then, all of a sudden, we got now Israel uh, coming at Lebanon. They called it a preventive attack. God knows if that's true. I'm not in the intelligence, and even if I was, I wouldn't bet my farm on whatever the media are reporting, and they say it's coming from the intelligence. Yeah, maybe. And if the intelligence is there for a reason, why should it make the things it discover, right, throughout espionage and whatnot? Why would you make them public? So what's the point of having an intelligence service if then you public all the stuff you discover and you lose a tactical advantage? So even there, I just always take that with a grain of salt, for fuck's sake, right? But oil, all in all, this morning I'm feeling particularly humoristic. You know what? It might be the weather. So for oil, let's look at the break-evens, which are, yeah, they are following the price of oil. They are coming back a little bit. Should I say they're stabilizing a little bit after the big drop? But again, I keep on looking at it and comparing the trend with the price of oil. So, you know, in order to shift from being short to medium term bearish on oil, I should see the break even starting to make higher highs and higher lows, right? So inflation expectations should go higher. And that for oil might be in terms of pricing, right? Might be brought higher. But as for now, I don't see it. So I keep on being relatively bearish on oil for the chart for many different reasons, even beyond the break evens, right? So there was people ask me, why do you look at the break evens? Why do you think there is this relationship in between inflation expectations? And I found a very nice chart. I'm going to show you. These, of course, crude oil price versus the 10-year yield. And if you start from the left, you see that especially since 2023, the two moved in locksteps pretty much. I mean, yeah, you can see oil kind of is always the first mover. Oil peaks, and then the 10-year peaked. Oil bottomed, and the 10 years bottomed. And then again, oil peaked, and after a little while, the 10-year yield peaked. So, I guess it makes sense that, oil is moving first because oil is, energy is the economy. Oil is a fundamental part of how we do power stuff in our modern economies. So when the price of oil comes down, naturally that is translated and transmitted throughout all the chains in the real economy. If energy starts to cost less, everything in the manufacturing and transportation process will cost less, by reflection. So when you start to see that, yields, which again are what? A reflection or an expression of future growth and inflation expectations, they come back down because if oil gets down, you see inflation coming back down in the coming weeks, months, whatever you. And vice versa if oil goes up, right? Now, if you extend the time frame a little bit, if you start to look at it from the 2000s, from the beginning of the 2000s, so over the last 24, almost 25 years, you see the relationship. It's not as clear as it is in here, but it's kind of a little bit more mixed up. I mean, you can still see why sudden spikes in oil eventually lead to lower yields because it's just oil is inflationary up until the point is it's disinflationary because it goes up so much and it creates inflation so high that at a point consumers are tapped out. They can't just keep up with prices going up and they have to pull back, and if they pull back then aggregate demand evaporates, and of course prices will have to adjust lower to get back to meet demand, which is in the meantime is moving lower, right? So again, it's no surprise that when you see these divergences in between the price of oil and the yields, eventually the two would be converging. But surely over the last 1 year, 1 year and a half, the relationship is much more evident, I would say. But if you extend the time frame, just to try to be a little bit of objective here, if you extend the time frame, it's not always so close, right? Just just to point out something. Then gold, discussed gold this week with Lotus. We both of us we do have different ranges, but overall we were kind of agreeing that all gold at this point it's still good for some upside. Um, I was expecting again, as I said last week, a little bit of a more pronounced pullback. We didn't have it on Friday. It just bounced back up, and it closed the week. I guess if you go on the weekly, this is some sort of a doji, maybe. Yeah, it's the week. The week started here, so not much going around on oil except these retests of this level, which was broken out of. So, again, I keep on standing positive on gold. Uh, I think we're going to see higher prices in gold. Um, there was that divergence on the RSI, and if I use one of the indicators I use for my day trading, which is the CDV right here, you might say, yeah, it's going up, the cumulative delta volume is making lower highs. So should it mean this move is likely to go exhausted in a relatively short amount of time? Um, Maybe. Who knows? I mean, one way I would see it going like exhausted and having a massive and sharp drawback, a pullback, it would be if we have a liquidity event of some sort, right? When where people have to liquidate the gold they have because they don't have any other way to access liquidity. But I mean, it doesn't look like that, at least at the current moment in time. Of course, things can really change in a dime, but I don't have the chart right here. I actually closed the tab, but I was looking the credit spread, and together with the VIX, they came back at levels which were previous values compared to what we've seen after the unwinding of the carry trade with the yen. So I mean, it looks like it was a big shock, but it was just momentarily, and then it just went away. You might argue after a volatility spike like that, it's almost impossible that you don't have casualties or bodies on the ground. Someone must have been hit, and we might not know about it for a good amount of time. Like in some places, like I guess Europe and mainly the US, if you have a major hedge fund blowing up, it's gonna be reported, right, relatively quickly. If you got some other institution, let's say in Asia, which is going bust on these yen carry trade unwinding, maybe the especially I don't know, I'm thinking about the Chinese. Maybe these people they don't report stuff up until they are forced to, like your quarterly report that you have to compile and to publish. Maybe it's going to be evident there when you look when we I can speak English when we can look at your balance sheet, right? But who knows? For now, the important thing is that gold is going up, and the trend is a trend. So up until the state of liquidity and the order flow is this one, no major worries about gold. Bitcoin. Bitcoin had a more than a decent bounce from this area. Uh, with some sort of a slow reaccumulation in here after the big drop, the huge bounce, and then at a point it was looking like continuation, and then continuation was negated. And when you see it, see an imbalance, rebalance, and then it fails to have continuation, the more it can stay around here, the more it can get stable, the more the likelihood of an up move filling in the rest of the imbalance which was created is likely. Now, this is a particular interesting point on Bitcoin because I was looking at it, right? The same pattern right here, and immediately my eyes went back to here, right? We got a sharp move down, a V-shaped recovery, and then price gets stable a little bit, and then it pumps, and then it keeps on pumping. Could this be? Um, you would need to reclaim this level first, and even if you can grind right below it, kind of eroding it, it would be a good sign. But I mean, if we use the same type of logic that we were using with gold, I don't know, it looks like the volumes are not suggesting something like it. Although, volumes are always relative. Oh, well, this is a cumulative delta, so it should have a little bit more of legitimacy compared to the pure volumes up here. But I think, it's probably going to follow what the rest of the market will do, okay? So if, let's say, equities can stay up, Bitcoin might at least all these range and not really cracking down. So for the moment, I'm neutral on Bitcoin. What could you have? I don't know, just throw some shit just for the sake of it. A little bit of a pullback into here, maybe, and then see if we can start to reattack this apex resistance right here. And then you might say, okay, then if I see it flipped, like price goes up, retest it from the other side, and then you might want to go long, targeting, where would I target? Actually, I would target this area right here. Yeah. As a first trouble area, like just looking at the past, right? We kind of got back into the weeks as the shadows of the candles, right? Like in here, in here, in here, and then in here. So this area might be the first trouble area. Even if you want to play the level flipping, hmm, could be. Of course, it's kind of pointless to do this shit now because then you got maybe 3 4 days of price action and everything could go out of the window when price starts to move. But just to have a general idea what you could wait for or whatnot. Now let's move into the bulk of the topic right here of the video, yields. are relatively stable. They're still on the path of going down, especially the long end. It looks like the long end is a little bit weaker compared to the others right now. Um, Bonds on these rate cuts confirmation, they really didn't move a lot. You know, Thursday they came down a little bit, and then Friday they were up. And of course, when they were up, the short duration was up more than the long one because, of course, the Fed can only influence the short end of the curve. The rest is influenced by market forces, as it should be. I mean, I would advocate a lot for interest rates being set up by the market itself instead of some policymaker. But yeah, it's kind of pointless to wish for things that we might never see again. So it's going to remain a wet dream of mine, I guess. Um, okay, so now talking about Powell and what he said and how Fed funds and therefore yields at the short end of the curve of the duration should move. I was looking at a little bit of things. Now, if you look at Fed Watch, essentially, this is basically if you take the September implied rate cuts starting from August 23, so basically 1 year ago, this is what you see, and this is basically what the futures market was pricing in for this specific date we're getting into, so September. It's going to be September the 18th. Yep. And basically, the market starting 1 year ahead of it was pricing in, as you can see, first it was it would be maybe a quarter of a percent cut, and then they were really at the beginning of this year, 2024, they were thinking and pricing in what's that? More than a 1% cut. So you can see how these things shifted around and really was all over the place, and the market constantly changed his mind of about what the Fed fund level would have been in September 1 year ahead. So sometimes you can look at the Fed watch. I'm not saying it doesn't have any validity at all. I'm just saying it can vary. It can ebb and flow a lot because the market is hit by new data points, and every data point which coming out, it's constantly shaping and shifting and changing and modifying the thoughts that the market has for the future and how is forward looking. So I guess that they might be useful if you're looking at them for maybe short-term type of ideas and trades. But would you put on a trade with a long-term type of a time horizon, knowing that these things can move this much in just a span of 1 year? I mean, it starts to get complicated, I'd say. So this is basically what happened. Now, if you go down the curve, I mean, if you try to look into the future and what Fed funds futures are pricing in, you see that basically this is the path. So you got the implied Fed funds for the future. Now, the market is basically saying that the Fed, it's most likely going to cut from 5 point something down to 3, mid 3, and then they are gonna stop cutting and they might hike again. Now, in my view, this is basically the Goldilocks scenario, right? Where you went for your hike cycle, um, the economy just normalized, and then you can sustain higher rates going into the future. So if rates goes up, if yields goes up, what's that? Future growth and inflation expectations. So you're basically saying the economy is now perfectly healthy, and we are gonna expect economic growth into the future, and therefore yields and rates should go higher because the economy will be able to sustain their higher rates. So that's what the Fed funds futures are implying right now. But if you look, let's get back a minute. So that would imply what from five. let's use round numbers, okay? So let's say from 5.5 Fed funds down to 3.5. I know it's not the exact numbers. I'm just trying to deliver the concept. Then we can discuss about the decimals and whatnot. But this is what they're pricing in. But if you look at history and you look at the easing cycles the Fed performed, you can see that very rarely they went for a very soft type of easing cycles, right? And especially if you look after the 70s, after the great inflation, after the times of Paul Volcker and whatnot, you see that most recently, after the 80s especially, what do you get? 10%, 5% more, almost 7, 1% in 95, 98, all right? Then 5%, 5%, 2.4% 2019, 2020. Now, so you might say, starting from the 80s is a good chunk of time. What's that? 50, 60 years back in the past. It's a good type of a sample size, I'd say. And it basically reflects how the market evolved and changed more recently, right? Uh, and you notice that when they cut aggressively. They don't cut 1, 2 percentage point at a time. The two outlier, if we want to call them outliers, would be 1995, 1998. But there's only one thing, in my view, with this. Throughout this period, you didn't have an inverted yield curve. So is it? I mean, that would be the only one time over the last 60 years where they achieved the so-called soft landing. But you didn't have the market telling you that they were expecting the hard landing. So is it a bit of an outlier? Yeah, but in this sense, in my view, not in the sense of the percentage change. All right. And then, of course, you might say 2020, 2019, 2020, they cut just 2.4. Yeah, of course, because they couldn't cut more. They cutting this much, they already reached into the low zero boundaries. you know, it, Cutting more would have mean bringing rates negative. So that's why you see these. Um, Now the implied cuts are 2.23%, as shown in the previous charts. Will it be? Sure. Now, if you think about it with bonds in mind, the scenarios are of two types, in my view. They're going to cut, so the bonds, as you know, as the prices of the bonds should go higher, because even if they cut 2.5%, there is still the inverse relationship, right? So I guess there is still a little bit of a buck for the bang, no, bang for the buck, yeah, bang for the buck, in staying in bonds if you are playing for the price appreciation. But maybe it won't be the same as if we get into a recession and they need to cut aggressively. Um, on the other side, if these implied cuts are not correct, they might cut even more, and so that you see bonds going really higher. So basically, what you should pay attention to in these two potential scenarios is basically soft landing versus hard landing. That's all there is. Okay. So the cost opportunity in staying in bonds right now, it's basically um, built up on the premise of what you do expect getting into the future, and especially in 2025. Okay, my bet is they're not going to be able to cut as they say, and they are going to have to cut more. But who knows? The good thing about it is that I got time to decide because they're going to cut a little bit more at least, so I can still play a little bit of a price appreciation in bonds, and then see how the economy performs over the next 6 months, maybe, just to get an idea, and then I'll see what to do. But This is basically the two things you need to pay attention. Um, it's strange though, because even if the market is pricing in this soft landing when it comes down to Fed watch and Fed funds, if you look at how the Fed is looking at it and the expectations that the Fed is having right now, I mean, they're even worse than what they were in 2019 before getting into the pandemic. So they are forecasting GDP lower. They're forecasting an unemployment rate a bit higher. PCA basically stable, and Fed funds should be higher in their view. Hmm. So economic growth will be marginally, slightly slower, but Fed funds should be higher. I, it looks to me a little bit like a contradiction, but I mean, I don't know. Could it be? I keep on betting on my thesis that they're gonna cut and they're gonna be cutting aggressively, but it's gonna take time to see that, right? Uh, the forecasts are saying that the projected real GDP it's gonna be flat around what one 2% more or less, maybe a little bit below it. So why would you? So yeah, I mean, if you think about it, real growth at and around 2%, CPI around 2%. So having rates at and around 2.5, 2.8, as they say, you still maintain positive real rates. So everything is good. The economy can actually sustain positive real rates, and the economy is growing, although not so fast. But 2% for a mature economy like the US, it's not bad. So again, it looks like they're forecasting this Goldilocks, but I see a little bit of a contradiction into it. Guess you're gonna have to wait and see for it. Another thing, beside the Fed projections and whatnot, to just try to transition the next topic. Another thing might be where people are saying, for the vast majority of time now, there was a huge opportunity cost in staying into money market funds because basically it was free money. Uh, the the chance of losing those money is technically zero. They're all overnight transactions, and you basically get in transactions which, on an annualized base, they are yielding you 4.5%, and the risk is zero because it's all collateralized. And even if it's not, I mean, everything is granted. It's Fed funds, so it's the Fed paying you. The Fed can't go bust. So why shouldn't you stay in T-bill? T-bill and chill, right? Now they say, okay, if they are dropping rates, that opportunity will go away. Yeah. So if that opportunity go away, those money which are parked into these money market funds, they're gonna have to seek yields because you're gonna see the yields in that um, environment being eroded or declining. You pick the term you want. So they're gonna have to seek new yielding opportunities elsewhere. So the narrative is they're gonna seek the stock market and equities for much better returns. Now, okay, see, yeah, basically this is what they say: 6 trillion in cash on the sidelines in money market funds, essentially. Uh, all right, but let's have a look at these for a moment, because I mean, I'm not arguing the fact that those money will come out, but I might argue with the fact that it's not a said and done deal that they are going to chase the stock market higher, right? So what if? Well, first of all, let's look at these because to put things in perspective, right? Um, if you compare how the stock market went up, so how the market capitalization changed over time, and the relationship it had with money market funds, you can see that even if you believe that, you know, money market funds are at levels they were seeing in 2018-19. So even if you accept the fact that these money are going to chase the stock market higher, but if you compare the relationship and how the relationship evolved, there wouldn't be that much of a boost to the stock market, right? Or should it be? I I don't know. I'm not really buying into this narrative that just because people are gonna take money out of money market funds, they're gonna invest everything they got in the stock market, especially when you look at the macroeconomic data, right? Plus the election uncertainty, policy risks, because policies which have now been talked, and you see a lot of marketing for these policies, but then you don't know who's gonna win, and even if you kind of start to see who's going to win, you don't know how much time it's going to pass before those policies are actually implemented. And then you need to face that dilemma about what if this president win, but the House is made of the opposition. So, just for example, what if the Democrats win, but then the Republicans they win in the House? It's going to be particularly difficult to pass bills if the House is on the opposite side, right, of the presidency. So the, I don't really see all these cheering up. So basically, I don't get the point of people being massively bullish the stock market and other risk on assets just because you see rate cuts coming. And these are a few reasons for it. Now, I'm not saying the stock market will have to crash. I'm just saying be very careful what you extrapolate out of a single piece of news, because then you look around and you see that many things you might take for granted are just not so crystal clear, and especially they're not a said and done deal. It's like that quote, right, from who was that? Mark Twain, I guess. It's not what you don't know that puts you into trouble, is what you I'm paraphrasing, of course. It's what you take for granted and just ain't so that puts you into trouble, right? So I guess this was a little bit of an interesting topic to bring on, because people tend to take things at face value. um, and I also like to remind you that if you look at what happened every time we had rates, Fed funds dropping, more often than not, we were into a recession or approaching one, right? So, I mean, are rate cuts good or bad for risk on assets, therefore equities, even Bitcoin, right? I At least, I had a very interesting conversation just the other day talking about Fed cuts, Bitcoin up or down. What do you think? And my answer is I didn't have a definitive answer, because I was looking at Fed funds against Bitcoin price, and there were times where Fed funds was going up and Bitcoin was going up. Fed funds were coming down and Bitcoin was still going up. Then Fed funds came down even more and Bitcoin goes down. Then Fed funds kind of um, revert, keeps on going higher, and Bitcoin just plateau. And there wasn't this relationship, this crystal clear relationship. So I said, unless you're cherry picking data just to fit your bias, be very careful when you make these sort of assumptions, because the logics behind them, in my personal and very humble view, tend to be very influenced by what you can read on Twitter, on the mainstream media, and from all these podcasters, YouTubers, and influencers. So always be very careful with those sorts of assumptions because it can put you into trouble, right? So just, I'm not saying I know what's going to happen. I'm just saying at least I try to detect and to analyze the situations and be aware of the risks. Again, as I always say, where am I wrong on this? What happens if I'm wrong? How can I know if I'm wrong? Those, instead of picturing the price of your favorite asset going up 100% over the next year, what should keeps you up at night? What if? What if I'm wrong? What happens if I'm wrong? How much do I risk to lose here? That should be the type of logic you should apply. And that's why I'm always very hesitant to put on my bullish hat, my bull's hat, right? I'm not to say that I'm not bullish on something. I'm just saying I tend to be very very careful. Um, Enthusiasm can be very dangerous at times. So I try to stay as agnostic as I can, right? Now, after these tangent, what tangent? I think the since we got the Jackson Hole thing, right? I think this was particularly relevant, so that's why I brought that up. But now let's have a look at the stock market, right? Now, stock market, and these are ES futures, and you see it basically reclaimed many different levels in this V-shaped recovery, and the last one, which was resistance back in beginning of August, has been now reclaimed, retested, bounced, a little bit of another draw back into it, and we closed the week with a little bit of, well, uh, I would call it strength at this point, especially because we are so close to all-time highs. So again, just people, I guess sometimes people read more into what you say than what is really there, right? Um, I often come across like a perma bear. I'm not. I'm not. This chart, if you ask me, this is fucking bullish as the current moment in time. You got V-shaped recovery. The market just reclaimed every single point of potential resistance and it just blasted through it. If you still want to be bearish, be my guest. I'm not bearish. Okay? I'm just saying the risks are still there and you should be always cognizant of the risks, right? That's it. Even if you look at the ETFs, right? I mean, it sounds cool. Like the Qs reclaimed the 50 days moving average, retested it, and for now is holding it. At the same time, the exponential on the RSI has been reclaimed, retested, and now we are in at a good level. It's not at extremes, but it's not in the bearish type of zone as for the indicator, right? Stochastics is high, right? Which is usually good enough from a technical standpoint. You see in a trending market environment, the stochastics tend to stay high for a good amount of time. Um, and volatility is coming down. So after the shock of the yen carry trade unwinding, everything is getting back to quote unquote normality, and the trend is a trend. Now, again, to to be faithful to it, just look at one thing. Notice one thing. You see that right now, what's really leading the race to the upside is the S&P, while the Nasdaq is lagging a little bit behind. I might be wrong on this because usually I might be wrong on many different things, but I would prefer to see the Qs or the Nasdaq leading the race instead of the S&P. There are two aspects into it which I think are both, good but with a caveat. And the fact that we had a massive drop and now the S&P is going higher and it's going higher faster than the Nasdaq, at face value, it tells you that the breadth of the market has widened, which is a good thing because now you have more stocks participating in the rally. So it's much more of an organic type of rally. It's not like it was before where people were saying, yeah, the stock market is going up overall, but basically it's just Nvidia, Apple, Google, and Microsoft. But now what you see is a little bit more of an organic and broad type of upside move, which is good, right? It should be good. But look at these, just for the sake of it. Over the last 5 years, right? And, I guess beside the parenthesis with the Rona dump in 2020, which was where? Which was here, right? So over the last 5 years, if you take the Rona dump, I know it's not correct, but let's just say as a one-off, if you try to smooth out the data and look at a very much larger time frame, you might say that stocks went up, right? The equities went up. Okay. So while they were going up, and you see the average, the absolute return in the 5 year period for the S&P was almost 100%. And who was leading the charge? Communication services. Now I'm looking at the sector, right? Communication services, discretionary, because of course, if consumers are good, they're going to spend more on things they want instead of on things they need, right? That's the very simple nature of discretionary spending. Industrial, so even the industrial sector was going good, and technology, without a shadow of a doubt, right? And what was underperforming? Consumer staples, real estate, and utilities. That is normal. If you look back throughout the last 15, 20 years, that's how uh, a bull market should perform. And these are the sectors that you expect to to perform better on average than the others. But if you look at the month of August, basically starting here with this massive dump and the V shape again, right? If you look at the month of August and this V shape, who's leading the charge? Communication, not so much. I mean, yeah, they are going up, but slowly. Oh, consumer discretionary went down. Hmm. Industrial, marginally up. Real estate, sorry, technology. Technology is down. What happened to the AI mania? Hmm. And who is instead overperforming relative to the others? Oh, consumer staples, real estate, utilities. Now, look at these two charts. They are basically the opposite, right? You would expect, I guess, why, if it was working up for the last 5 years, at least in these data set, why would you expect to be completely flipped? Now what was lagging is actually leading, and what was leading massively by a huge amount is now lagging, if not underperforming and being negative. And again, this is just another warning sign in my view, which you should pay attention to. That doesn't mean the stock market will crash next week, next month. That doesn't mean that we are not going to see new all-time highs before the end of 2024. It just means that there is something underneath the surface that you need to pay attention for. If you start to combine all these things together, the rate cuts, how the different sectors of the equity market are performing, what other leading indicator, well, not really leading, but let's say macro indicator, like the sum rule showing the yield curve inverted. If you start to pile in all this stuff all together and you try to make sense of all of these, my ultimate type of assessment is that the chart is bullish, And when I do trade, I trade the chart I have. I trade the market I have. I can't trade the market I would like to have. That's for sure. All I'm saying is there are many, many more risks now compared to, I don't know, 2, 3, 4, 5, 7 years ago. Or just, simply put, even uh, throughout the middle of 2024, where the stock markets were going up and you were looking at the data and they were particularly better than now, both for unemployment, both for retail sales, both for, I mean, you could look at a good number of things and just name the first two, but everything was suggesting that things were kind of in line, both from a price action standpoint and from a fundamentals type of standpoint. Okay. And since I just mentioned retail sales, let's have a look at retail sales because this is a very strange type of data point that people look at. It's very, I'd say, confused more often than not, um, and it's very volatile. Okay, I, in my view, this is volatile because it can be influenced by very a lot of seasonal type of factors, like could be holiday season, it could be back to school season, it could be spring break. So all, all these things are moments throughout the year. It could be Black Friday, Thanksgiving. All these moments throughout the years that actually bring consumers to spend a bit more. So when you have a data set which is so volatile, sometimes it's hard to make sense of what's really going on. But at the same time, it's important to know what's going on in these type of um, data because they tells you a lot about how the consumers are feeling. And getting back to the beginning of the video, US economy, 70 to 80% is consumption. So consumers are driving the economy at the end of the day. Now, uh, so this is basically the last data point, which looks particularly good, right? It was good if you compare it to the others, right near to it, okay? But then you look at the trend, eh, it's not. When you start to look at the trend and when you start to make adjustment for it, you'll see it's not that good. Now, this is basically what happens and why retail sales might be relevant. You see that when they flatten out, you are most likely in a pre-recessionary period, right? So it's important to look at them and see how they are behaving. Now, of course, you might say, I can't look at this and comparing to the chart you were showing before. No, but there are ways by which you can smooth it out, okay? Now, the current type of a drawback, or let's call it stagnation in this data set, is a little bit elongated. I wonder, might be because we injected so much money into the economy and we helicoptered checks in in households, mailboxes. Therefore, they found themselves with a hell of a lot more money to spend in the real economy than what they would have had if you didn't helicopter money to them, right? So, although it might be a little bit elongated, I think still at the end of the day, you can't just erase the business cycle. At a point, things are gonna, you're gonna, how do they say? You're gonna have to pay the piper, they say in America, right? So something like it. So look also at how, the data is very volatile and it's highly influenced by seasonal occurrences. But look what happens when they revise the data. You got the initial release, and then after 1 month, 3 months, they can revise the data after new data are coming in, which help to interpret the data that you were looking at, let's say 1 month, 3 months ago. And you see over the last, how many are these? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Over the last 12 releases, 8 of them have been substantially revised lower. So again, are consumers feeling that good? I don't know. This is just show the volatility of the data I was talking about. Uh, and I was reading this basically this is everything of everything you're looking at is taken by a blog post I found. So we are gonna need to trust the source, I guess. I mean, I don't have any particular doubts these data are correct, but beyond the actual accuracy of the data themselves, because I can feel and I can agree with the fact that especially when it comes down to CPI, right? The people are saying, yeah, but those data they are not accurate. Uh, uh, they are faked. The books are cooked. Yeah, I get it. So even if you might question and arguing against the validity of the accuracy of the data, there is one thing that you can still appreciate. Although you think the data is a little bit overstated, understated, and whatnot, but you can still appreciate the trend. So if you take the retail sales and you look at something like a 12-month average of the percentage change, you kind of have a better insight in what the data is actually telling you. I know it's low, I know it takes time, but it doesn't lie at the end of it. So again, this is just another thing to look for. And look where are you now? That's not very cool. That's not very enticing for sure. So I guess there was another one. Oh yeah. Uh, Well, it's a little bit more of a long-term type of thing, right? So it just says that starting from 2010, you don't have the same type of a growth in retail sales that you were looking at before 2008, 2010. So basically, as we often say, with the monetary system, with the backbones of the financial market, and now with the retail sales, something clearly broke out in 2008 and it has never been fixed. Because you see a lot of stuff, even for GDP, everything is below trend. If you look at a trend that was going on since, let's say, the 80s, 90s into the 2000s, we are substantially below trend when it comes down to growth and to many other different things, like, in this case, retail sales. So, all of these, it's not, of course, as usual, it's not to say go out, liquidate every single thing you have, and get back into, I don't know, uh, gold, treasuries, or just stay in cash, you name it. I'm just saying, if you go off of one simple sentence, which express one simple narrative, as in rate cuts are bullish. I'm gonna quote one of my good friends now. He said, by no, looking at potential rate cuts coming. And I quote, so don't hold me responsible for the abusive language, but he said, my dick is so hard now. And I was like, okay, I mean, absolutely. Each one of us has the right to have an erection, right? So don't spoil people's feelings. But the point I'm trying to bring home here is, of course, in the very short term, the market is going to be what the market is going to be. And what you look at on the charts most likely is a good reflection of what the market will do in the very short period in the future. I'm just saying, um, while you are enjoying your physiological dynamics there, just bear in mind that it really doesn't take a lot to turn it all the other way around. Okay, And especially when it comes down to this stuff, like, I was looking at sentiment, and I know this is going to be a long video, but I think these stuff need to be said because I feel like a lot of people are not really considering them. So, speaking about enjoying and the feeling and feeling pumped about something and expecting something happen, I say that has a lot to do with confidence, sentiment and whatnot. So when we think about sentiment, I always think, when I look at a chart of whatever asset it is, and I explained that in a video I recorded, I think it was 3 weeks ago, maybe. In my view, sentiment is always a reflection of price, and sentiment can shift when price is moving in another direction, counter to sentiment, to the current sentiment. Now that is true if you're just looking at a chart, if you're just looking at price moving around. When you talk about sentiment on a macro scale, I think there are other considerations to be made. And again, they are going to play out much more slowly than a simple chart of the NQ on a 5 minute, right? But eventually they're gonna hit. So I guess it's safe to say that one of the major driver for overall sentiment, and I'm not just talking markets now, I'm talking the real economy, right, as a whole, or even society, if you want. One of the main driver for sentiment, so being positive on the economy, being negative on the economy, right? And it's very important, by the way, because depending how you feel about the economy and the future, where you see the economy and where you see it going, that is going to impact your economic choices. And your economic choices now are going to be, you know, are going to impact the economy of the future. So as I said, depends on how you feel, depends on the sentiment, right? The feeling of people now are going to shape the sentiment of tomorrow, the price action and the economy of tomorrow. So if people are not optimistic, let's say they have fears, they are worried, they might end up being the same catalyst for, you know, those fears to actually materialize themselves in the economy and therefore in markets, which is why sentiment might be important on a larger scale. So we might agree that one of the major drivers for sentiment is your ability to have an income. So your job, your labor situation, and maybe not only yours, but the situation of your colleagues, your relatives, your friends, people right? So it's safe to say, in my view, that if you think you're gonna have a job next year, you're gonna feel positive. What happen? What happens if a good chunk of people are gonna start to feel in danger of being able to maintain the job in the future? The behavior is gonna change, together with sentiment, of course. Spending habits are gonna change, and it might impact or aggregate demand, and therefore the economy and economic growth. So let's have a look at these. And I opened two. I don't know why. Now, first of all, just for the sake of it, I was looking at Fed funds against the unemployment rate. And it is no surprise that when you see rates cut, usually the unemployment rate is already going up because the Fed, as any other central bank, is a reactive type of institution, not a proactive one. So they're cutting rates because they see the labor market is deteriorating, right? So another reason why you should be a little bit more careful with saying it's going to be bullish if they cut rates. Well, are we? Because every time they do is because the unemployment rate is going up, so more people out of jobs, so more people with no more monthly income, no people with spending capabilities, no more aggregate demand going up, most likely going down. So that would be the first one. Now, let's see how people are feeling a little bit. Uh, as you can read in the title right here, right? It looks like people have a little bit more of worries now for what concerns their career, their jobs coming into next year, even more than what they had when getting into the pandemic. So I mean, and then you talk about sentiment. How is sentiment now? Now these are all survey, as you can see. So it's not a bunch of guys in a room, mathematician and statistics, putting together stuff and saying this is it. These are actually interviews that have been conducted and people have been asked. So this is the vox populi, the Latins should say, right? Uh, so it's not particularly cool seeing something like it. Then you look at this is the University of Michigan survey in regard to the expected change in household income during the next year. It's just plunging. So what does it mean? It means that a good chunk of households are actually expecting to see their income being declining getting into next year. Now you might say, okay, but is it what's the magnitude of it, right? I mean, is it going to be so atrocious? Because, yeah, we might have a decent chunk of the population which are going to review or diminish or change their spending habits. But, on average, consumer spending is not that bad. I mean, we still have that chunk of the population, the top 20%, they are going to keep on spending. So what's really important is the average, is the mean, right? Hmm. Well, first of all, I would suggest to pay attention to the terms because the mean, which I see as the average, right? The mean and the median are two very different concepts and two very different calculations. So, and one is much more accurate than the other in grasping the situation of whatever data set you're looking at. Okay, I'm not gonna get into it now, but you just Google it, mean versus median, and you look for yourself which one is the best for having an accurate read on whatever type of data set you're looking at. Okay, but the point is, even a small amount of people have, experiencing this shift in sentiment might be relevant. Now, I agree with what if you tell me, yeah, but billionaires or people with a hell of a lot of money are not going to change their habits because they got money anyway. Yeah, sure. I mean, Jeff Bezos and Elon Musk most likely they are going to keep on ordering the same bottle of crystal when they go out for dinner. But many other people, even in the higher income tier of the population, they're going to review a little bit of their change of their spending habits. I'm going to tell you that it always happens. And just to and again, I was looking at a podcast just yesterday, and I guess this was a good example. Now, look at this restaurant right here, right? If you look at the two pics, they are basically the same. The only difference is this table right here in the front with what? Three people, right? And I'm gonna take the calculator now because I don't remember the numbers correctly. But so you might say, okay, so the restaurant maybe was able to serve all these people, let's say 50 people that can be sitting there consuming, eating. Is it that much of a difference if now they don't have these three people anymore? Well, if you subtract three people from 50, that's a 6% decline. And if you start to think of a 6% decline in aggregate demand, in aggregate consumer spending, that is here now and it's here no more tomorrow. That is that is a substantial change, especially when you start to think about all these businesses. What do you think the margins they have are? Because if you see a 6% type of decline in your revenues and your margins were, let's say, 3-4%, now you're operating on a negative cash flow. So you are operating at a loss. How long can you sustain that before starting to actually cut the staff? And if you cut the staff, what's going to happen? You're going to have more people unemployed, which are not going to go into restaurants, even your own, and you're going to see revenues keep on going down. And maybe at a point you're going to say, you know what, it's pointless to keep on going like this. I might shut down the business. I can't operate at a loss for 6 months, 1 year, and whatnot. It's pointless. So you see why looking at all these data sometimes can give you a little bit of a different picture, and at least, again, not completely uh, changing your mind on what you should do with your trading activity or investing activity, especially in the very, very short term, right? But at least it can give you that warning signs, and it can help you a lot assessing the risks you are taking on right now compared to what it might have been previously. So, a little bit of a long video. The topics were a lot, the charts were a lot, the data were a lot. Um, I'm guessing, yeah, probably nobody stayed till the end, but yeah. Anyway, I these are the kind of stuff that really keeps me interested. I mean, I basically spend my week looking at the fucking 5 seconds charts of NQ, and when I want to research something new, when I wanted to dig my nose into something I know a bit less of, this is the stuff I want to research into, and it's for me those are nice informations to have. So well, I guess I'm a nerd. That might be. Anyway, with all of it, um, I wish you a good Sunday, or what's left of it, at least half of it, in our time zone here in Central Europe. And as usual, be nice and be cool. Neil's out.